Today we're going to do an analysis of 3M. Now, I really dug through the numbers on this company, and we've got a lot to go through today, so stay tuned. Let's go. So for the past 5 years, they're down 44%, which is pretty horrible performance when you consider that the S&P 500 is up like 75 or 80%. But maybe this presents a buying opportunity. Let's check it out. So market cap of 50 billion, pretty large company. Not like insanely large, especially I'm pretty sure 3M. Well, 3M used to be a bigger company, of course. But yeah, $50 billion company. Its price to earnings ratio, there is none right now, but that's because of litigations. And they have a dividend yield of 6.5%, and that probably won't change anytime in the future. Let's take a closer look at their financials, and we can see a lot of good information in their financials here. Their total revenue has been pretty flat for the past 7 years. Makes sense. They haven't really grown at all. Their share price has fallen. So it makes sense that they haven't really been growing their revenue. And their margins have been pretty flat as well. They've been pretty much 16% like the whole way through, except for this last quarter or this last year. They actually had a non-operating expense, and that was $15 billion in unusual expenses. And that is a legal claims expense. Hit them so hard, $14.5 billion. And that's probably why their share price has fallen so heavily. Also, let's check out their balance sheet. And in terms of their net debt, it's 10.8 billion, which isn't bad. Their equity is not that high, just because they've got a lot of different assets and liabilities. But yeah, in terms of net debt, it's not too bad. Although that will probably be increasing in the future. Okay, yeah, you can see right here between 2022 and 2023, you can see their book value just drop considerably from 26 to 8, and that is because of the legal claims expense, and that just turned into a liability on their balance sheet. Most likely to pay it, they're going to have to treat it kind of like a debt payment, because of the terms of the agreements, and we'll go through that later. But yeah, we're going to have to count like an extra 15 billion towards their net debt when we do the cash flow model on these guys. In terms of their cash flow, they actually have pretty healthy cash flows, 5 billion last year, and they pay 3.3 billion of that in dividends. So they still have like a healthy ratio there, and they still have like a 6% dividend. Although they did do a spinoff, so their cash flow is probably going to drop quite a bit in the future. Let's take a look at what they did actually. So I have this right here. They do expect to do a spin-off of 3M Healthcare. They've got the healthcare business, and they did do a spin-off, so we can take a look at that later. Probably tomorrow we'll do that. And yeah, they've got these different public works, water systems, and combat earplugs settlements. So there's some settlements that are going on. And let's take a look at this Savolt. So 3M completes spinoff of Savoltum. So this is the healthcare side of their business. Never knew that 3M had a healthcare side, but they do. And it turns out that holders of 3M common stock received 1 share of Savoltum for every 4 shares of 3M stock that they held as of March 18th, 2024. So if you were holding 3M, then you just got free Savoltum stock, and that currently is worth like $63 a share. So good job on that. But yeah, in the future, their Savoltum and 3M are going to be disconnected, and so that's why their revenue and their cash flows are going to drop by quite a bit actually, because Savoltum was at like 20% of their business. Taking a look at their settlement. So we've got the 3M settlement with public water supplies, and this is the conclusion of it. And the conclusion is that they have to pay $10 billion over 13 years. That's what you have to get from this. And the combat arms agreement, they will pay a $6 billion between 2023 and 2029. So $6 billion in 6 years. In terms of what the analysts think, well, the analysts think that their earnings are going to be 7.49 per share, and their revenue is going to drop by 18% or almost 20% down to 25 billion and then drop a little bit more down to 4%. And then I'm guessing it will stay pretty steady or keep up with inflation after 2025. So I actually plugged this stuff into the DCF model. Actually, we'll check that out later, but let's look at what the insiders are doing. Well, the insiders haven't bought or sold any stock in the last 4 quarters, so that's actually a good sign. Well, 3 quarters. So that's actually kind of a good sign. It means that they don't want to sell at these current prices. So, yeah, it means that they probably think that the price will go back up. But let's take a look at the DCF model. I put the EPS estimates here, revenue estimates. I actually think that the analysts are like dead on probably on their estimates. They're probably very close. And buybacks of 0, they probably won't be doing any buybacks anytime soon. And net debt of 25 billion. So they actually have a net debt of like 11 billion, but I counted those litigation issues as debt because they are going to have to pay those over the next 10 years or 6 years in the case of the earplugs one. So that's why I put their net debt at 25 billion. And a discount rate of 10% because I want a 10% return on all of my stocks. Exit multiple of 17. Right now they're trading at an exit multiple of like 10. Well, if you count their earnings that they had last year or a couple years ago, then it would have been like an exit multiple of 10. I think an exit multiple of 17 is totally fair for this business, especially once they get back to normalcy, which should be by 2030. And in terms of earnings growth, it's pretty flat. I just have them growing basically with inflation at 2%. And in this case, then their fair share price is going to be $108. But because they've got that debt, then it's probably somewhere in between. I'd put them around $90 a share. So they are trading at fair price right now. Definitely not terrible to see that. And then in terms of their revenue with margins, they're expecting negative 4% into 2025 in terms of their revenue growth. And the profit margin was 16% before this whole fiasco. And I do expect that to continue. Although the debt might hurt their margins because we are treating this as debt and it's going to be increasing by 15 billion. So their profit margin is probably going to decrease down to 15%. At least that's what I think is going to happen. Feel free to think that their profit margin might continue to go up to like 16 or 17, but I think it's going to drop down to 15. And their revenue is probably going to keep in line with inflation at 2%. And in this case, then their fair share price is around $97 a share. But if you account for debts, then it's probably around 80. And so that's probably why the stock has been bought up around $75, $80 a share. And their dividend payments probably just going to continue to grow in the future. So let me check that chart again. And yeah, you can see right here in October and in February, it actually got bought up twice at $75 a share and $78 a share. So that is a double bottom. And I don't know if we'll see a price like that again in the future. Maybe it could drop down to like $83 a share, and then it will probably get bought right back up just because the fundamentals are still strong on this business, even though they've had those litigation issues. Anyways, that is the analysis. Feel free to debate me in the comments. Let me know what you guys think. Also, if you want to use that DCF model that I showed you in the video, then just check the link in the description. You can use it completely for free. And yeah, hit that like button, and I'll see you in the next video.